Tesla is a car company. That is what most people believe. That is what most people would say if you asked them right now. And honestly, that belief makes complete sense. Tesla sells electric vehicles. Tesla built gigafactories. Tesla disrupted the automotive industry. For years, the story of Tesla was the story of cars. But here is the thing about stories. Sometimes the part that everyone is watching is not actually the most important part. Let us start with the numbers that seem to confirm the obvious. In fiscal year 2025, Tesla generated roughly $94.8 billion in total revenue. Out of that number, $69.5 billion came from automotive sales. That is 73% of total revenue. So yes, on the surface, Tesla is still a car company by revenue. That is not a small share. That is nearly 3/4 of everything the company earns. If you stopped the analysis right here, you would walk away confident. Tesla makes cars. Cars make money. End of story. But the moment you look one layer deeper, that confidence starts to crack. Because here is what that revenue number does not tell you. It does not tell you which parts of Tesla are growing and which parts are stalling. It does not tell you where the money is actually going. And it does not tell you what Elon Musk is betting the entire company on. When you look at those details, the picture starts to look very different from what most people assume. Let us talk about energy. Tesla has a division called Energy Generation and Storage. Most people have heard of it vaguely. Some people associate it with the Powerwall, the home battery product. But in 2025, this division generated $12.77 billion in revenue. That is 13% of total revenue. It does not sound massive compared to cars. But here is where it gets interesting. In 2024, Tesla's energy business grew 67% in a single year. Automotive grew 1%. While the energy division was nearly doubling, the car business was essentially standing still. And then there is the margin question. Tesla's automotive gross margin sits at around 15%. The energy division's gross margin reached 29.8% in 2025. That is nearly double. Every dollar Tesla makes selling Megapack battery systems to utility companies is worth almost twice as much as every dollar it makes selling a Model 3. When you combine those two facts, growth rate and margin advantage, you realize something that most financial headlines completely miss. Energy is not a supporting segment anymore. Energy is quietly becoming one of the most powerful profit engines Tesla has ever built. Adam Jonas at Morgan Stanley called Tesla Energy, and this is a direct quote in spirit, one of the most underfollowed businesses in his entire coverage universe. That is an analyst who covers some of the largest companies on Earth saying that a 13% revenue segment at Tesla is being ignored by almost everyone watching the stock. That should make you pause. But even energy, as surprising as it is not the biggest piece of the puzzle. Because when you look at where Tesla is actually spending its money, something much larger comes into focus. In 2026, Tesla announced capital expenditures exceeding $25 billion. To put that in perspective, that is nearly 3 times what they spent the year before. Where is that money going? It is not going into new car factories. Tesla made a decision that stunned many traditional auto industry analysts. The company announced it would discontinue production of the Model S and the Model S, two of its most iconic and long-standing vehicles, and repurpose the Fremont, California factory entirely for Optimus robot manufacturing. Think about what that decision actually means. Tesla looked at one of its most established production lines, a line that had been building cars for years, and decided that robots were more important than those cars. That is not the decision of a company that sees its future in automotive. That is the decision of a company that is betting on something else entirely. The Optimus robot program is officially described by Tesla as still in its research and development phase. Musk himself admitted in January of 2026 that no Optimus robot was yet doing useful work inside Tesla's own factories. So this is not a mature product. This is a vision. But the scale of that vision is almost difficult to process. Tesla's stated target is to produce 1 million Optimus robots per year at the Fremont facility by 2030. The long-term goal for Gigafactory Texas is 10 million units per year. If you price each robot conservatively at $20,000 per unit, 10 million robots per year generates $200 billion in annual revenue. That would be more than double Tesla's entire current revenue from everything it sells today. No car company in the history of automobiles has ever casually described a potential $200 billion business as a side project. This is where Tesla starts looking very different from what most people expect. And it is also where the comparison to other companies becomes essential. Because if you try to understand Tesla by comparing it to Ford or General Motors or Toyota, you will always be confused by the valuation, the strategy, and the decisions. Those comparisons do not work anymore. The comparisons that actually explain Tesla's behavior are Apple, Amazon, Microsoft, and Nvidia. Think about what Apple did when it introduced the App Store. Apple had built its reputation on hardware. Computers, iPods, iPhones. But the App Store transformed Apple into a platform company. A company that takes a percentage of every transaction on its platform. The hardware became the entry point, not the product. The product was the ecosystem. Tesla appears to be executing a nearly identical strategy. The electric vehicle is the entry point. Every car sold is a sensor on 4 wheels, collecting real-world driving data around the clock. Tesla has over 1 million active full self-driving subscribers as of the end of 2025, which represents 38% year-over-year growth and was the first time Tesla had ever publicly disclosed that subscriber figure. Each of those vehicles is contributing training data to a system that Tesla is building towards something far beyond navigation assistance. That system lives inside a facility in Austin, Texas called the Cortex Supercluster. As of April 2026, Cortex-2 went live and began executing active training tasks. The cluster runs on 50,000 NVIDIA H100 graphics processing units plus 20,000 units of Tesla's own custom artificial intelligence hardware. Total power draw at launch was 130 megawatts, with plans to scale to 500 megawatts by the end of 2026. 500 megawatts of computing power is not an automotive investment. That is the infrastructure of a major cloud computing company. For context, major data centers operated by Amazon Web Services or Microsoft Azure consume roughly similar power footprints. Tesla is building the kind of computational backbone that you build when you intend to train artificial intelligence systems at a scale most companies cannot imagine. And here is where the full picture starts to come into focus. Tesla is simultaneously building 3 things that most people are tracking separately, but that actually function as a single interconnected system. First, it is building a massive fleet of vehicles that collect real-world data. Second, it is building the computational infrastructure to process that data and train autonomous systems. Third, it is deploying those trained systems into a robotaxi network and a humanoid robot workforce. Each layer feeds the next. More vehicles mean more data. More data means better artificial intelligence. Better artificial intelligence means more capable robots and more reliable autonomous driving. More capable autonomous systems mean higher revenue per vehicle and eventually revenue that has nothing to do with selling vehicles at all. The robotaxi business is where the financial math becomes almost uncomfortable to look at. Today, Tesla earns approximately 15% gross margin on each car it sells. Analysts modeling Tesla's robotaxi operation project gross margins in the range of 70 to 80%. That is the margin structure of a software company, not a manufacturing company. The Cybercab, Tesla's purpose-built robotaxi vehicle, is expected to generate approximately $1 billion in revenue in 2026, which represents a small but real beginning. By 2030, some projections place robotaxi revenue at $75 billion, which would represent roughly 45% of Tesla's current automotive sales, generated from a business that did not exist a few years ago, at margins that are more than 4 times higher than traditional vehicle sales. At this point in the analysis, a question becomes unavoidable. If Tesla is spending $25 billion on artificial intelligence and robotics infrastructure, shutting down legacy car production lines to build robots, deploying a supercomputer cluster at data center scale, building a robotaxi network, and describing itself repeatedly as an artificial intelligence company, then what business is Tesla actually in? Elon Musk has said it plainly, more than once, in more than one venue. Tesla is an artificial intelligence company. He has gone further, describing Tesla as a physical artificial intelligence company. a company that intends to embed intelligence into machines that operate in the physical world, not just the digital world. He posted in March of 2026 that Tesla would be one of the companies to achieve artificial general intelligence, and likely the first to achieve it in a humanoid physical form. Now, it is worth noting that under oath in a separate legal proceeding, Musk stated there were no concrete plans to pursue artificial general intelligence at Tesla. That contradiction is real and it deserves to be said out loud. But whether or not the artificial general intelligence ambition is literal, the capital allocation, the infrastructure investment, and the product roadmap all point toward a company that is building far beyond automotive. Cathie Wood at ARK Invest has described Tesla as the largest artificial intelligence project on Earth. Dan Ives at Wedbush named Tesla his top artificial intelligence stock for 2026, setting a price target of $500 per share and a $2 trillion market cap projection by the end of that year. Gene Munster at Deepwater Asset Management called Tesla the most innovative company currently operating, placing it ahead of Apple, Google, and Nvidia. These are not fringe views. These are some of the most widely followed technology analysts in the United States, and none of them are primarily describing Tesla as a car company. But here is where credibility requires honesty. Because the case for what Tesla might become is not the same as the case for what Tesla has achieved. And those two things are genuinely different right now. Automotive revenue is declining. Total Tesla revenue fell 3% in 2025 compared to 2024. That was the first annual revenue decline in the company's history as a public automaker. Net profit fell 61% in the same period. Optimus robots are not yet doing useful work in any factory. Full self-driving still requires human supervision on every drive. The robotaxi service has been delayed repeatedly. Tesla's Dojo supercomputer project, which was supposed to be a core piece of the artificial intelligence infrastructure, was shut down in August of 2025 after being described internally as an evolutionary dead end after $500 million had already been invested into it. 8 open investigations from the National Highway Traffic Safety Administration remain active. Competition from Chinese electric vehicle manufacturers is intensifying on global markets. None of these counterarguments are small. They are real risks on a real timeline with real financial consequences. So here is the question worth sitting with. If Tesla executes on even half of what it is building, what do historians eventually call this company? A car company that got lucky with batteries. An energy company that happened to start with vehicles. An artificial intelligence company that used transportation as its training ground. A robotics company that disrupted manufacturing the way it disrupted automotive. Or something that does not have a clean category name yet. Here is what you think. Is Tesla actually on the verge of becoming something no one has seen before? Or is this one of the most expensive and ambitious pivots in corporate history that may never fully land? Drop that in the comments, because the answer is not obvious, and the people arguing on both sides of this debate are not stupid. This is genuinely one of the most contested business stories of this decade. What is not contested is that the transformation is already underway. The margin data is real. The energy growth rate is real. The capital allocation is real. The infrastructure being built in Austin is real. Whether Tesla reaches the finish line it is describing is the open question. But the direction it is moving away from automotive as the primary identity and toward artificial intelligence, energy, robotics, and autonomous platforms, that direction is not speculation anymore. The car was never the destination. It was always the vehicle. And if you want to stay ahead of what this industry is actually becoming, not just what it looks like today, stick with us. Subscribe so you do not get caught off guard by what is coming next.